Somewhere in America right now, a couple is some papers on a Subway franchise. They've done the math. $15,000 for the franchise fee. Cheap, as these things go. A few $100,000 more for the build-out, and they're in. World's most franchised restaurant on earth. Surely a name that big means the money follows. That same couple, working the counter themselves, might clear less in a year than a first-year school teacher. Not because they're bad at business. Because one store was never the plan that was supposed to work. On paper, Subway looks like the easy way in. $15,000 for the franchise fee is a fraction of what most big-name chains charge just to use their logo. All in, build-out included, you're looking at somewhere between $240,000 and $400,000, depending on the market. Some estimates push past $600,000 once you count every hidden line item, legal fees, working capital, the tech setup nobody mentions in the pitch meeting. Either way, next to a Chick-fil-A or a hotel franchise, it's pocket change, low door, big brand. That's the whole sales pitch, really, and it's not a small brand, to be fair. Subway is still, by location count, the largest restaurant chain on the planet. Tens of thousands of stores, over 100 countries, more outlets than McDonald's. So the logic writes itself. Cheap to get in, everywhere you look, must be reliable, a known quantity. The kind of business a first-time owner can point to and think other people have already proven this works. There's also a cost that rarely makes it into the initial pitch at all: remodeling. Subway has spent the last several years pushing its franchise system through a company-wide redesign, and thousands of existing owners have already been asked, or required, to commit their stores to it. That's not a one-time buy-in cost. That's a bill that can land years after the original investment, on an owner who thought the hard part, the opening, was already behind them. Here's where the dream starts quietly lying to you, though. Being the biggest chain by store count says nothing about how much money moves through any single store. And on that measure, Subway isn't just behind the leaders. It's not in the same category. A typical Subway does around $420,000 a year in sales. A typical Chick-fil-A does over $9 million. Same word, franchise. Same categories on paper: food service, real estate, staff. Completely different machines underneath the hood. So the door is cheap because the machine behind it is small. You're not buying your way into a money printer. You're buying into a low-volume, low-margin operation that happens to share a name with 20,000 other low-volume, low-margin operations. And there's a second problem hiding behind the first one. There are a lot of those operations, packed close together. Subway spent decades chasing store count above almost everything else, and at its peak it had more than 27,000 locations in the U.S. alone. That strategy built the brand recognition new owners are buying into. But it also meant a Subway on one corner was often competing directly against another Subway 3 blocks away, both splitting the same pool of sandwich buyers, both paying that same 12.5% fee on whatever they could scrape together. The brand's own growth engine, in other words, occasionally worked against the very owners it was signing up. Now follow the money, layer by layer, because this is where things really split apart from the pitch. Start at the top. A typical Subway pulls in about $490,000 a year. Sounds respectable. $500,000 moving through a sandwich counter is the number a franchise broker leads with, and it's not technically wrong. It's just not the number that matters. Before the owner sees a dollar of that, Subway takes its cut. 8% goes to royalties. Another 4.5% funds the national advertising account, the pool that's paid for decades of $5 foot-long commercials. Added up, 12.5%, gone before the lights bill is even paid. That figure isn't just high in the abstract either. Most quick-service franchises take somewhere between 8 and 10% combined. Subway sits well above that. On a $490,000 store, that's more than $60,000 gone before a single ingredient or a single hour of labor gets covered. What's left has to survive 3 more layers: food cost, labor, rent. On a smaller sample store doing $250,000 a year, the pattern looks like this: $75,000 in cost of goods, bread, meat, cheese, produce, leaving a gross profit around $175,000. Then rent, Utilities and payroll eat another 100,000 of that. Scale the same shape up to the more typical $490,000 store, and the picture holds a big top line and three separate hands reaching into it before the owner ever does. The franchisor, the supplier, the landlord, and the payroll. Labor in particular is where a lot of owners quietly bleed money without ever seeing it on a single line item. Manually built schedules, the kind a lot of single-store owners still do by hand on a Sunday night, tend to run with something like a 15% labor cost premium compared to schedules built around actual hourly sales data. On a typical store's labor budget, that gap alone can run $15,000 to $20,000 a year. Money that isn't stolen, isn't wasted on bad ingredients, just quietly overspent because nobody had the time or the tools to staff each hour to the sales that hour was actually going to bring in. It's the kind of leak that's invisible on any given week and enormous by the end of the year. So what's actually left? This is the number that should be on every prospective owner's whiteboard before they sign anything, and somehow it almost never is. After royalties, the ad fund, labor, food cost, and rent, a typical single-store Subway owner walks away with somewhere between $58,000 and $73,000 a year. Other industry estimates put the range even wider, as low as $30,000 on a bad year, rarely above $75,000 even when the stores run well. Read that again. $250,000 to $400,000 invested, sometimes closer to $500,000 once every hidden cost gets counted, to end up with essentially a salary. Not a business in the wealth-building sense. A salary, minus the safety net a real job comes with, plus every bit of risk a small business carries. That's the twist from the very top of this video, now with real numbers underneath it. The world's most franchised restaurant chain, and a single store might pay its owner less than a mid-career schoolteacher takes home. There's a fifth layer, and it's the quiet one. It doesn't show up on any individual franchisee's paperwork, but it explains a lot about who's actually thriving inside this system. It's called a vendor rebate. Here's roughly how it works. When Subway negotiates bulk pricing with its suppliers, the bread companies, the meat distributors, the packaging vendors, part of that deal often flows back to the franchisor as a rebate, not to the franchisee. And over the last couple of years, as royalty payments across the system have actually fallen by around 10%, those rebates have quietly become a bigger share of how the parent company makes its money. Total revenue on the corporate side barely dipped, even while the number of paying stores and the royalty stream both shrank. Worth sitting with that for a second. The franchisor found a way to keep its own math working even while individual stores were struggling. The owners didn't get that same cushion. So here's the full shape of it, side by side. $490,000 moves through a typical Subway every year. More than $60,000 of it never makes it past the franchisor's cut. Another sizable chunk disappears into food, labor, and rent. The same three costs that eat every restaurant alive, Subway or otherwise. What survives all of that, for the person who signed the lease, financed the build-out, and probably worked the counter themselves, is something in the neighborhood of a modest salary. One layer up, meanwhile, the company collecting the royalty keeps finding ways, vendor rebates among them, to hold its own revenue steady even as the number of stores paying into it shrinks. None of this makes Subway a bad business, exactly. People buy sandwiches, the transaction works fine. It's a story about where the top-line number and the bottom-line number quietly stop resembling each other, and about who's positioned to fill that gap and who isn't. Which raises the obvious question, why does one Subway pay a salary, while the same brand, same royalty rate, same sandwich recipe, turns into real wealth for someone who owns 2,000 of them? The answer isn't that multi-unit owners are smarter, or work harder, or get some secret discount on turkey breast. It's a lot more mechanical than that. And once you see it, you'll start noticing it in half the businesses around you. Every Subway carries a set of costs that don't shrink no matter how small the store is. Bookkeeping, payroll processing, inventory reconciliation, someone checking that the vendor invoice actually matches what got delivered, instead of quietly getting overcharged a few $100s a month. A single store owner has to absorb all of that themselves, either by doing it personally, at the cost of their own time, or by paying for it at a price that barely moves whether the store does $200,000 a year or $600,000. That's the trap. The margin isn't just bad, it's being taxed twice. Once by the franchisor's 12.5%. Once by fixed overhead that refuses to shrink to match a small store's revenue. Now watch what happens with a second store. And a third. The bookkeeping doesn't double. The reconciliation work doesn't triple. One back office, spread across 5 locations, starts absorbing a cost that used to eat an entire store's profit on its own. Multi-unit operators tend to feel that shift once they cross into the 3 to 5 store range, where a centralized back office can replace what would otherwise run $40,000 to $50,000 a year in in-house admin per owner. $40,000 to $50,000. That's not a rounding error. That's most of a single store's entire annual profit, freed up just by spreading one fixed cost over more revenue. This is the actual mechanism. Not more stores, more sales, which is obvious and frankly a little boring. Fixed cost dilution. The royalty stays at 12.5% no matter how many stores you own. Nobody negotiates that number down. What changes is everything underneath it. The admin, the training, the loss prevention systems, even the owner's own time, because those costs are largely flat per owner, not flat per store. At one store, the fixed cost eats the whole margin. At 20 stores, that same fixed cost barely registers against the combined revenue, and the 12.5% royalty becomes the only real ceiling left standing. And Subway knows this, by the way. The company isn't sentimental about the single-store dream it was originally built on. A few years back, Subway quietly shifted its own recruiting strategy, steering new candidates away from the one-store starter path and toward operators who can commit to multiple units from day one. That's not a coincidence, and it's not generosity. It's the franchisor acknowledging in its own language that the math doesn't hold up well enough at one store to keep an owner invested, or to keep them from feeling like they bought themselves a stressful, low-paying job. You can actually watch this trap show up in the brand's own history. Subway peaked at more than 27,000 U.S. locations back in 2015. In the decade since, that number has shrunk by roughly a third, down under 19,000 today. That's not really a story about sandwiches falling out of fashion. It's a slow-motion sorting process. The stores carrying too much fixed cost against too little revenue closing one by one, while the operators who'd already spread that fixed cost across multiple units kept absorbing the survivors. Subway's shift toward multi-unit recruiting wasn't a separate decision from that contraction. It was, in a sense, the company catching up to what its own numbers had already been showing for years. So the trap here isn't hidden fees, or a landlord quietly taking more than their share, or a supplier squeezing the franchisee. Those are other businesses' stories. This one's simpler and a little colder. The fee structure was built assuming scale from day one. A single store was never really the target customer. The multi-unit operator was. If you want to see that play out in a real family instead of a spreadsheet, look at the Gruels. It starts small, almost quaintly small, in the early 1990s. A man notices an acquaintance doing well running a Subway and gets curious enough to look into it himself. The investment level was lower than most other franchises, and the return looked strong. He and his wife opened their first store. For the first 2 years, she runs the counter while he keeps his day job as an accountant. That's the whole empire at the start. One store, one couple, one income barely worth mentioning. In 1991, his brother joins the business, and together they buy a second location. Not long after, he leaves accounting behind for good to run Subway restaurants full-time. And then the growth compounds in a way that's easy to state as a fact and hard to actually picture. By 2006, 15 years after that second store, the family had opened 25 restaurants. 25, already a serious multi-unit operation by most standards, and still, in this family's story, basically the warm-up. That same year, they get named business development agents for Los Angeles, essentially becoming Subway's own scouts and deal-makers for new franchisees in the region. Over the following 8 years, their territory expands into Orange County, Canada, and Washington, D.C. By the time that expansion settles, their combined footprint sits close to 2,000 restaurants. Today, that same family controls more than 2,100 Subway locations across multiple states and into Canada, the largest single Subway operator in the country. Trace that arc from start to finish. One store, run by a couple with a day job on the side, to 25 stores in 15 years to 2,100 stores today. That's not a franchise success story in the vague, motivational poster sense. That's the fixed cost dilution mechanism from a minute ago, played out at real scale, decade after decade. Every additional store making the back office, the purchasing, the training system a little cheaper per unit, until the whole operation stops resembling 2,100 individual sandwich shops and starts looking like one very large, very efficient logistics company that happens to sell subs. There's a small detail buried in the family's own account of those years that says as much about the mechanism as any spreadsheet could. As the store count climbed into the hundreds, one of the family members started giving district managers an actual ownership share in the group of restaurants they oversaw. 5 or 6 stores apiece. Not a bonus, a stake. Because once you're running that many locations, you can't personally watch every register anymore. And the only way to get someone else to watch it the way you would is to make it partly theirs too. That's fixed cost dilution again, just applied to trust instead of paperwork, spreading the one thing that doesn't scale, an owner's own attention, across people who now have a real reason to supply it. Now hold that up against the other side of the same system, happening in the very same years. While operators like the Gruels were compounding their way toward an empire, Subway as a whole was shedding stores by the hundreds. 631 net closures in one recent year, another 729 the year after. Those aren't random failures. They're disproportionately the single-store owners. The ones still carrying that flat back office cost against a store doing $400,000 or $500,000 a year, still watching royalties and rebates and rent take their bite before they see a dollar, still one bad lease renewal away from walking away entirely, same brand, same royalty rate, 12.5% off the top for everyone, no exceptions, and 2 completely different outcomes, sorted almost entirely by one variable. How many stores stood between the fixed cost and the store's own thin margin? So who actually wins here? Not the version the brochure sells. The version that's actually true once you follow the money all the way through. Best case, you're the Gruel family. 2,100 stores, decades of compounding, a fixed cost that quietly disappeared into the size of the operation years ago. At that scale, Subway stops being a sandwich business. It's a real estate and logistics machine wearing a sandwich brand, and it throws off real, generational wealth. Worst case, you're one of the 631 stores that closed last year, or one of the 729 the year after that. You signed for $250,000 to $400,000, worked the counter yourself to keep labor costs down, and still cleared somewhere between $30,000 and $70,000 a year. If you cleared anything at all. You didn't buy a business. You bought a job, a nerve-wracking one, with your own savings as the entry fee. And then there's a third position, quieter than either of those, because it was never really playing the same game to begin with. The franchisor. In 2024, a private equity firm bought Subway outright in a deal worth more than $9.5 billion, funding much of it with new debt loaded onto the company's own books. Royalty revenue across the system has fallen since. Store counts have shrunk, and yet, through rebate income and a deliberate shift toward exactly the kind of well-capitalized multi-unit operators who can absorb its fee structure, the company sitting above all of this has kept its own revenue holding remarkably steady. Even as the ground underneath individual owners keeps shifting, it never had to open a single sandwich shop or explain a P&L to a single nervous first-time owner to come out ahead. Subway didn't build the world's largest restaurant chain by making a Subway profitable. It built it by making scale the only version of the business that was ever going to work, and then handing out a $15,000 door to anyone willing to believe otherwise.